Hey everybody, welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related to help us all grow our dividend stockpile. In today's video, we're going to be discussing three top quality REITs that are currently on sale. As you know, I love REIT investing, and it's actually a 15% portion of my portfolio. To check out my entire REIT portfolio, check out the video popping up now or at the end of this video. So in addition to being on sale, these top quality companies have great properties, strong management, and sustainable dividends in addition to being at a discounted price. So if you want to add more passive income through real estate investment trusts, check out these three undervalued stocks to add to your watch list today. So let's go. All right, so here we are inside of the allreits.com's website. It's my go-to resource for all things REIT investing. We're going to utilize their tools to identify the three quality REITs that are undervalued that you may want to consider today. So to start off, we go down here where it says Screen REITs, and it's going to give us a REIT screener of all of the different REITs in their universe. And we can filter it a couple of different ways, but for today, I'm just going to filter it by US only REITs. And then inside their tool, I'm going to filter it by their score. Now, if you guys have watched my previous REIT video, you know how all REITs works. They have a ranking system that they rank 6 different criteria for each REIT, and they give it a numerical score between 0 and 100. So 100 means that the REIT hits all 6 of their metrics at 100%. So looking through the top listing REITs, you see quite the familiar names, but there's 3 in particular I wanted to review today because they are undervalued in a couple different metrics. The 2 metrics that we're going to use to determine undervaluation is the price to FFO or AFFO, depending on the company, and also the dividend yield theory, which states that if the current yield is higher than their historical yield, that means they're potentially undervalued. Most companies will revert to the mean, meaning they'll go back to their average yield. And so as the price goes up, the yield goes down to match the historical term. So right now, these particular REITs that we're going to talk about have a higher dividend yield than their 5-year historical average, which considers them to be potentially undervalued. So there's a lot that we can choose from, but I went ahead and identified 3 different companies that are undervalued. The first one that we're going to look at is Alexandria. And with that, you can see that they're an office REIT. And a lot of people be like, oh, office REITs, no way, especially after COVID, no one's going to. But this one is very special. Instead of having the traditional corporate tenants, what this particular company does is they focus on life science, technology, and ag tech campuses with AAA innovation cluster locations. So you can think of your pharmaceuticals, your medical testing type of companies, the Mercks, the Pfizers, the Bristol Myers Squibb, so on and so on. They focus on those types of tenants, and it's a very specialized niche because those particular places need laboratories and research centers and all kinds of different things. They also focus all their properties in clusters, as it said before. So I'm going to go ahead and go to the Alexandria website to show you kind of a little bit more about what the company does. So they've been around for 30 years, and they focus on mega campuses and key innovation clusters. So the clusters that they focus on is Greater Boston, San Francisco, San Diego, Seattle, Maryland, the Research Triangle in North Carolina, as well as in New York City. So these aren't your typical Class B offices in the middle of nowhere. These are very specialized laboratory things, and their tenants are all top quality in the research and medical field. They take long-term contracts for their tenants, and they're in popular locations that are going to be appealing to both new hires as well as people who want to raise a family. So looking at each of the locations, you can see how they have quality research centers in the middle of town and the most popular locations. These are not some far-flung locations that they have. It's very popular for the tenants as well as the employees who work there. All right, switching back over to allreits.com, let's take a look at their metrics. So the first thing I'd like to look at is the price to AFFO. And currently, Alexandria has a 12 times AFFO. So that's very low compared to the historical average of 17.3. So if you think of that as percentage-wise, that's highly undervalued. Looking at their returns over time, you can see that it has not performed very well over the last few years, especially right after COVID. It's been in a downturn. But that being said, it provides a good opportunity to pick up this top quality REITs at attractive valuations. All right. Scrolling down some more, you can see their dividend history. They did have to cut a little bit in the 2008-2009 financial crisis, but ever since then, it's been a steady increase in dividends over time. Scrolling down here, you can see their estimated forward dividend growth is 2.4%, and their 3-year is 4.2, and the 5-year is 5.3. Their payout ratio is very reasonable for a REIT at 55.6%. And the other thing that causes them to be undervalued is their yield. As I mentioned at the beginning, if the current yield is higher than the historical average, that shows that it's potentially a good value. And over time, the yield typically reverts back to the mean at 3.5. So if the yield goes down, that means the price goes up. So you'll be able to take advantage of it. Scrolling over their financials, as you see, AFFO is up and to the right. AFFO per share is up to the right. So even if they dilute by creating more shares, they're still receiving more income for those new shares. Debt to assets is a reasonably low metric. Occupancy rate is almost 95% and is very stable over time. And their largest tenant is Moderna, but that's only a little bit of their, 5.8% of their tenants is that one company. And so you have the proper diversification among tenants. The average lease time is 7.5 years remaining. And all REITs is great because it also, in addition to give you the high level, they actually go through all the different financials as well. So if you look down here at the bottom, you can scroll to the right. It has all the different metrics that you would need to identify whether the company is strong and meets your needs. It shows it by quarter and also by year. So scrolling over, you can see all the different metrics that they have. The debt to EBITDA, the average interest rate, which is sub 4%, which is excellent. Interest coverage ratio means how much income they receive to cover the interest payments, and they're at 13.5 times right now, which is very strong. And you can see the occupancy that we talked about earlier has been very stable, and they have a little over 400 different properties. So scrolling back up, that is Alexandria Real Estate. Again, they are an office REIT that focuses on the life science, technology, and ag tech campuses. According to all REITs, you get a perfect 100 out of 100 score of all their different metrics, and it looks undervalued today. All right, so looking at the next REIT that I want to talk about today is called American Homes for Rent. So this is a leader in the single-family home rental industry. So a lot of the residential real estate REITs out there are focused on apartments or manufactured homes, but this is one of only a few companies that focuses on single-family homes. They are focused on certain geographic locations, which we'll talk about later. And as you see, they get a perfect 100 out of 100 score from all REITs. So going to the American Homes for Rent website, you can see, just like we talked about, it's single family homes that you can rent. What I really like about this particular REIT is, in addition to finding backfill individual properties, they can lease out entire neighborhoods. So they work with builders to build out entire neighborhoods that are only for leasing. And so as you see, they have things as fenced yards, nice countertops, stainless steel appliances, and 2- and 3-car garages. So these are not your lower end real estate. They're nice houses and state-of-the-art amenities like pools and fitness centers and so on. These are places that people would love to be able to live. Scrolling up to the top, we can look at some of the different communities that they have. I'm going to pick one. I live in Tampa, so I'm going to see what they have around here. As you see, there's quite a few different properties and neighborhoods available here in the Tampa Bay area. And they have locations all throughout the country, mostly in the South and Southwest, to take advantage of the changing trends of people trying to move to the Sun Belt regions. All right, looking back at all REITs, you can see that the current price to FFO is 20.1, and their 5-year average is 23.8. Over the last year, they haven't done so great, but if you look over the long term, those are very respectable returns for a real estate investment trust. The dividends were steady for quite a while, but they have been increasing over the last 4 years, and they're growing extremely fast. So the forward dividend growth estimate is 18.2% a year, and their 3-year CAGR is 40%, and their 5-year is 55%. So as you see, this one is growing very fast, and they're raising their dividend extremely fast. The payout is still reasonable at 59%. And based on yield, they are potentially undervalued. Their current yield is 2.97, and their 5-year average is 2.12. Looking over their financials again, up and to the right, quality FFO growth per share. The debt to assets is extremely low, and their interest coverage ratio is solid, with only an average 4.3% interest rate on their debt. Occupancy has been maintaining in the mid to low 90% range, and this is the individual houses that they own, their rental. So if you think about all the different properties they own, 95% of the year, they're occupied, which is very good in real estate. A lot of times in real estate, if you're doing single family homes, you expect the house to be empty for 2 months a year. But as you see here, because of their system and their reach, they've been able to manage a 95% occupancy. And they have almost 60,000 single family homes throughout the country, and the average rent is $2,200 a month. So again, these are not the lower end rental properties. These are quality single family homes that growing families would like to see and live in. All right, looking at their financial reports, you can scroll over, you see all the different things that all REITs provides you. And it's a great way to do a quick screen or to do further research on any one of these REITs that you want to look at. If you like what you see here on all REITs, they do offer a free version, but I have the premium version, so there's additional things. You can add watch lists and dashboards and things like that. If you are interested in their premium plan, I am a partner of theirs, and so you can get a 10% discount on the annual membership by putting in Div Stockpile in the checkout, and you'll get a 10% discount for being a viewer of Dividend Stockpile, and you'll be able to access all the benefits that all REITs can provide. And while you're at it, if you like this information I'm providing, please give me a like and subscribe if you haven't already. It really does help. Appreciate it. Okay, on to the last one. So going to the last property I want to talk about today is EastGroup Properties. And so they are real estate investment trusts focused on the acquisition, operation of industrial properties in major Sunbelt markets throughout the United States. Emphasis on Florida, Texas, Arizona, California, and North Carolina. As you see, they've been around for 51 years. And they focus on the industrial properties, which we'll dig into in just a second by going to their website. As you see, here's a typical warehouse that they offer to their tenants. And what's great about this particular company is they like to focus on flexible distribution spaces. So they allow leasing from 20,000 to 100,000 square foot range, and they are looking to add additional properties all the time. And they have about 60 million square feet of properties. So scrolling up here, we can see the different properties that they own, the different states that they're located in. And if you click on each individual state, you can see some of the details of where they operate, some of the facilities that they have. So as you see, it's a distribution industrial type of setup. They own lots of different properties and lots of different top markets around the country. And they're where all the industry and customers are. So it's really great to see a company having this type of exposure to the quality locations throughout the country. So here in Tampa, where I am again, Expressway, Madison Distribution, Oak Creek, Palm River, there's a lot of different locations around the Tampa area that they have distribution centers and industrial properties. Okay, going back to all REITs, you can see they scored 100 out of 100 on their metrics internally. The price to FFO is only 20.8 compared to their 5-year average of 25, so very much undervalued. Over the last year, it's been relatively flat, but long term, they've had great results. You can see their dividends have been increasing, especially recently. They've really increased since COVID. So that's really great to see. They have a 38-year dividend streak, meaning they've been paying dividends for 38 years. So talk about quality. Their forward dividend growth rate is also excellent at an estimated 11.1% going forward. Their 3-year and 5-year CAGRs are in the 16% range, which is very strong, especially for a REIT. So you're going to get about a 3.27% yield with an estimated 11% growth going forward. That's an excellent combo. Payout ratio is still relatively strong for a REIT. And as you see, the yield is much higher than their historical average, which means it could potentially be undervalued. Scrolling down through the metrics, all the things you want to see, FFO up in the right, per share is up to the right, debt is going down, size, they're expanding their properties by an average of 6.8% a year over the last 5 years. Very strong and consistent occupancy rates. And their largest tenant is Amazon, but that only takes 1.7% of their properties is by Amazon. So they're very well diversified. Again, looking at all the metrics, you can look at a quarterly or yearly basis. You can see everything you want to see here in all REITs. All right, so those are the 3 properties I wanted to show you today. All 3 are showing multiple metrics of undervaluation. They're all top quality names in the real estate space. So hopefully this gives you an idea of what to start researching. Again, if you like all REITs and you like what you see here, make sure you sign up for their premium plan, the Div Stockpile in the checkout to get a 10% discount. Let me know if there's other names within the REIT space that you find are undervalued. Please put them in the comment below and we'll be able to talk about it as a community. Thanks again. Appreciate you joining. Remember, keep stockpiling those dividends.